Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together.
On today's episode, we are going to discuss what a mortgage actually is. Simply put, it's a loan that you take out to buy a property. Whether it's your dream home or a cozy little condo, a mortgage is what makes it possible for most people to become homeowners. When you decide to get a mortgage, you're basically entering into a legal agreement with a lender, usually a bank or a mortgage finance company. This agreement states that the lender will give you a specific amount of money to buy your property, and in return, you promise to pay that amount plus interest over a set period of time. The mortgage contract itself is very simple. It is the mortgage product details that require the most attention before signing the contract. Every product and lender is different, and each have their own terms and conditions when it comes to the details of the mortgage contract, such as how often payments are made, when you can make prepayments, how interest is calculated, even when or if you can pay the mortgage out fully. The product differences are vast. That is where a mortgage broker can help. We ensure that you are presented with products that meet not only your wants, but your needs as well. Here's the thing, mortgages are not short-term loans. In fact, they typically last anywhere from 15 to 30 years and are broken up into terms of 6 months to 5 years or even 7 and 10 years. That means you're committing to making payments for a pretty long time. With each payment you make, a part of it goes towards repaying the loan amount known as principal, while another part goes towards paying the interest on the loan. Speaking of interest, this is where things get a bit tricky. The interest rate on your mortgage is essentially the cost of borrowing money from the lender. It's expressed as a percentage, and it plays a big role in determining your payment amount. The higher the interest rate, the more you'll end up paying over the life of the loan. Now let's cover a couple key terms when it comes to mortgages. The first one is the down payment. This is the initial payment you make towards the purchase price of the property. It's typically a percentage of the total amount, and it can range from as low as 5% to as high as 20% or more. The higher your down payment, the lower your mortgage amount and payments will be. Next up, we have the loan-to-value ratio, or LTV for short. This ratio compares the mortgage amount to the appraised value of the property. For example, if you want to buy a house worth $700,000 and you need a mortgage of $560,000, your loan-to-value would be 80%. Lenders use this ratio to assess the risk and insurability of the mortgage, and generally a lower loan-to-value is seen as less risky. However, mortgages with over 80% loan-to-value, which are referred to as a high ratio or an insured mortgage, are also considered less risky since the lender is insured against default by the insurer. This is why insured mortgages and mortgages with a loan-to-value below 65% traditionally feature the best rates. Now let me give you a quick rundown of some common rate types available. First, the fixed rate mortgage. This is usually the most popular option because it offers stability. With a fixed rate mortgage, your interest rate stays the same for the entire mortgage term, which means your payment does too. It's great if you prefer predictability and want to budget your expenses. Next, the adjustable rate mortgage. As the name suggests, the interest rate can fluctuate over time. Along with interest rate fluctuating, the payment does as well. Movements in the Bank of Canada's lending rate will normally cause your lender to adjust their prime rate, and this will result in your payment amount changing on a future payment date, commonly the first one of the next month. The reason that your payment fluctuates in lockstep with changes to the prime rate is so that your amortization remains in place for the full term of the loan. Finally, the variable rate mortgage, which is commonly referred to as the static payment variable mortgage. This product is similar to the adjustable rate mortgage. However, the payment remains the same when there are prime rate changes, and instead the ratio of your payment to principal and interest changes. With this product, the amortization fluctuates, and during times of decreasing prime rates, your amortization reduces, versus extending in terms of increasing prime rates. Taking advantage of prepayment options available on your mortgage can help reduce your amortization or keep it in line when rates are increasing. The term variable is commonly used interchangeably for adjustable and variable rate mortgages. Therefore, it is extremely important to know what type of mortgage you have and how rate changes will affect you. Although your mortgage broker cannot know what is going to happen with future rates, they can properly prepare you of what to expect when changes do happen. All three rate products have their pros and cons. Ensure that the most suitable option is in place for you and your family. Another important concept is the mortgage amortization schedule itself. It outlines how much you'll pay each payment, how much will go towards the principal and interest, and how much you'll owe over time. Most mortgages have a monthly payment, but there are also options for bi-weekly or accelerated schedules. One thing to note is that not all mortgages are created equal. There are different types of mortgages suited for different needs and situations. These include, but are definitely not limited to, buyers that are new to Canada, purchase plus improvement programs where a buyer may find the perfect house that needs a bit of work, mortgages for self-employed individuals, or mortgages for investment properties. The options are endless amongst the different lenders. Now, I know all this financial jargon can get a bit overwhelming, but trust me, it's worth understanding. Getting a mortgage is a big deal, and the more informed you are, the better decisions you can make. That's why it's crucial to do your homework and educate yourself before diving into the home buying process. Understanding the process along with working with a mortgage broker is crucial to making sure you have the right product for you and your family. It's a big step, but once you know the ins and outs, you'll be better equipped to navigate the mortgage maze and make informed decisions. Till next time, happy house hunting.
Thank you for tuning in to Mortgage Foundations. And remember, every home starts with a foundation. Your mortgage should too.